Welcome to the Professional Edge. My name's Sean Todd, tax attorney, CPA, and certified financial planner. We have a pretty exciting session today, and basically we're talking about our listeners here on the Professional Edge being paralyzed financially. There's a lot going on in the stock market. We don't know which way to go with that, and the Fed is already met several times this year and raised rates 3/4 basis point, last two adjustments. So now we're approaching some significant turning points. The Fed is still looking at the red hot inflation numbers, and consumers continue to spend, but there's some cracks in the wall that we need to take a look at. And here on the Professional Edge, if you want to address what's going on, I do recommend that you visit our website, capitalatrisk.com. That is capitalatrisk.com. So when we talk about being paralyzed financially, there's been no real place to hide because we've been in this raising rate environment. And what I mean by that is we basically go back about 6 years where we're in a low to zero interest rate environment. Then all of a sudden, inflation came on the side, and part of that was attributable to COVID, and we're still trying to get that supply chain. And the reason why we had inflation, well, if there's a limited supply of goods, then we have to, have the same demand for a limited supply of goods, so that's going to bid up prices. So there is part of the reason we have this high inflation number, but then also inflation, if we have a lot of dollars in the monetary system, then they're, again, chasing a limited supply of goods. So if I'm going to try and build my back deck and there is a certain amount of 2x4s and 2x6s laying at Home Depot or Lowe's, doesn't matter which one we're talking about there, but then everyone decides to chase and go for that same lumber supply, which is limited, and it was limited based on the amount of supply being able to be produced because we did not go in and manufacture as much lumber. So when we have this limited supply, but we have this large demand, and you got to remember each one of us received these economic stimulus payments during COVID. So we have a lot more dollars chasing these limited supply of goods, and that creates inflation. Well, lo and behold, the Fed steps in and says, you know what? There's too much money in the money supply, and there is too much demand, so therefore we're going to raise interest rates. And if the cost of borrowing actually increases, then we're going to try and temper demand. So with that, then we changed into a raising rate environment on the interest rates, which therefore goes to higher prices on anything finance. Think of appliances, think of automobiles, and think of home mortgages. We were at less than 3% for a 30-year mortgage. Now we're cresting over 7% for a 30-year mortgage, and that will temper the demand for housing. So when you thought about it, this 60-40 bond mix, equities to bonds, 60% equities, 40% bonds, well, that model has not worked in this raising rate environment. So you, as a listener here on the Professional Edge, say, hey, part of my portfolio was supposed to be safe in bonds. Well, you know what? A 10-year treasury, that fell by greater than 10% in value based on these raising rates of the Federal Reserve. So that safe portion of your portfolio went down, and the equities have went down. So we are looking for where to go from there. So you may feel like you're paralyzed financially. You don't know which way to go. Well, we didn't stay in cash because we all know that cash wasn't paying anything. So that's why we're having our safe allocation in bonds and preferred stocks. Those are also interest rate sensitive. So where do you actually need to go? And one place is cash. It's okay to hold cash. We know that cash is finally paying a little bit of something. But here's also another thing. We talked about it before. It's an insurance product. It's called an annuity. And you can have an equity indexed annuity, which basically protects your principal from the market risk, so you're not even in the market. But for example, If the S&P 500 goes up 10%, it depends on your participation rate, and some of them will go 60%, 70%, 100% participation, but then there's also a cap on the amount of interest that they're going to credit you. So here's one, put this in your feather cap, and if you need more information, do give our office a call at 877-654-9798. That number again, 877-654-9798. So here it is. It's 4.9% guaranteed for 5 years. That's not a bad situation. So you get 4.9% guaranteed for 5 years. That's the latest one. A lot of these insurance companies have not been able to afford to give such a high rate of interest because the Treasury note interest was so low. And if you understand how the insurance company works, then it's a lot having to do with what the Treasury yield is on those investments, on what the insurance company can actually offer. So if 4.9% guaranteed for 5 years is of interest, do give our office a call at 877-654-9798. The other thing we have also is you got to say, okay, what if I need my money from the insurance company? Well, they normally have a free withdrawal, and it's usually based on a percentage. And underneath this one, it's a 10% withdrawal from the account balance. So if you put $200,000 in, you can withdraw 10% on that $200 is $20,000 without penalty, and that resets each year, so you're okay to access that penalty free. So again, this is a 5-year agreement, sort of like a 5-year CD. As this grows, it's going to be tax deferred, so you're not going to pay tax on that growth. And then at the end of 5 years, you get to decide what you're going to do with that. So you would get your principal back, again, based on claims paying ability of the insurance company. You only work with A+ and AAA companies. So therefore, that's a minimal concern, whether the insurance company is going to be in place to remit your original principal and the earned interest. So again, it is a 4.9% guaranteed for 5 years, and that's going to grow tax deferred. So at the end of 5 years, if you get your principal back and then you look and say, okay, I want to have my money and my interest, and you take that out of that annuity, then you would obviously pay tax on the interest that you accrued, but you would not pay tax based on your principal. So again, if that's of interest to you, give our office a call at 877-654-9798. That number again, 877-654-9798. The other thing, we're running into this last quarter of 2022, and I always challenge you as a listener here on the Professional Edge to get your estate planning done. And what I mean by that is if you have a last will and testament and you drafted that when your youngest child was born, and now they're actually going to college, well, it's time to give those documents a review and look at, because now we don't have to address guardianship anymore. And you probably have some antiquated decision makers within that document. So again, one place to go to get some information on that is our website, emcadvisors.com. That is Echo Mary Charlie Advisors.com. And on the right-hand side, there's a red button which says Ultimate Estate Planning Guide. Go ahead and request that. We'll send that out to you. And that gets the conversation started on exactly who you need to name as your decision makers and when should they receive these monies. So a lot of individuals just say, A, I'm going to give everything to my surviving spouse, and then B, if my spouse doesn't survive, I'm going to give the balance to my children. Well, if you don't position that in a trust, then your children will receive that at the age of majority. It's 18 here in Georgia, or later being 21 in other states. So at that point, they get a large lump sum check at 18. If you're like me and most everyone else, an 18-year-old with a couple $100,000, that's a recipe for disaster. So the recommendation would be that you structure that, place that money in trust for that child. They can access it for their health, their education, their maintenance, and their support, but they can't blow it. So then we trigger it to give out a third at, let's say, age 30, a third at 35, and the final balance at 45. So therefore, we are also asset protecting that from their creditors. And if they should get married early and get divorced before the age of 30, then these funds are separate property. So that's a key provision. So again, visit our website at emcadvisors.com, Echo Mary Charlie Advisors.com. And on the right-hand side, you're going to see the Ultimate Estate Planning Guide. Go ahead and select that, and we'll send that information out to you and get you started. So again, you'll reach your New Year's resolution to get your estate plan done before the end of the year in 2022. So back to being paralyzed financially. That is one thing. Where are you going to place things? Because we've seen the tech market get a complete routing. Intel's down, Nvidia's down. Amazon got crushed the other day because, quote, they said it might not be as robust coming into the holiday season. And sure enough, the market reacted and basically decimated, or as the markets say, the stock plunged. Well, at that point, that's a bellwether for commerce. They basically move a lot of packages, and it's all consumer spending. So where do you actually hide? And that's where listeners on the Professional Edge, we give a complimentary consultation. We can meet down here at the Cunningham Center in Columbus, or we can meet up in Atlanta, or if you're far away and somebody sent you this podcast link, then we can meet via Zoom. And to schedule that consultation, the number is 877-654-9798. That number again, 877-654-9798. So being paralyzed financially, it's okay to reduce some of your risk and see where things are going to go. We have some elections coming up here, and we're going to see if the House and Senate changes hands, and then we're also going to see which direction we're going to go with the Fed, because they're going to meet here at the beginning of November. More than likely, they're going to raise another 75 basis points. That's what the market is anticipating, so that will definitely move the 30-year mortgage rate above 7, maybe close to 7.5% rate, and therefore the cost of carrying that 30-year mortgage will more than double. So think about that. You buy a $500,000 home or a $300,000 home and you finance 90% of it. Well, your mortgage cost has doubled. So will that stifle some demand in the demand for housing? The answer is yes. Y-E-S. So should you be investing in a REIT, a real estate investment trust that has, let's say, commercial property? Well, we all know that we have not all gone back to the office. So therefore, their rents, their occupancy is falling off. We're not renewing as much space because people are working remotely. And the number that I saw was in New York City, their occupancy has reached 50%. So think about that. A skyscraper, 50% occupied, and the other part is unoccupied. How long can that sustain itself and keep the property improved? So if you are invested in a commercial REIT, I think I would have a second opinion on that. We offer that for our listeners here on the Professional Edge. Again, to schedule that consultation, 877-654-9798. That number again, 877-654-9798. More coming up here on the Professional Edge. My name's Sean Todd, and I appreciate you listening to the show.
With today's financial markets, are you getting the personal and professional attention you and your money deserve? Clients of estate management counselors benefit from having one set of professionals advise them on their tax, estate planning, and investment advice. We call that the Professional Edge. Sean Todd is a tax attorney, CPA, and certified financial planner. With over 15 years' experience, he welcomes the opportunity to assist you in preparing for retirement, implement effective tax planning strategies, and to help you properly plan your estate. His radio show, The Professional Edge, is aired weekly on Sundays at 9 a.m. If you're interested in meeting with Sean, call his office at 877-654-9798. That's 877-654-9798. Do you want to feel more confident about making the right investment, tax, and estate planning decisions? Today, these decisions are more complex than ever. Have you thought about working with a professional advisor and not sure who to turn to? Not sure what qualifies one to be an advisor? Scene Todd is more than qualified as a tax attorney, CPA, and certified financial planner. Scene is with Estate Management Counselors. Estate Management Counselors operates as an independent fee-only investment advisory firm. They're dedicated to gaining a personal understanding of their clients' objectives and implementing professional counsel and advice to achieve those objectives. So take a second to talk with Scene Todd to learn how you can benefit from their multidisciplinary practice where they coordinate their clients' legal, tax, and investment strategies into one comprehensive and integrated plan to enhance and protect their clients' financial security. You can reach Estate Management Counselors and speak with Scene Todd by calling 1-877-654-9798. That's 1-877-654-9798.